Hmm. Hello, good afternoon, everyone. Welcome to the BIBF and the BIBF webinar. This is Farooq Zafar from the BIBF Center of BIBF Center of Banking and Finance. We shall start the webinar in 2 minutes. Okay, welcome to everyone to the webinar. And now we will start our webinar and for the corporate tax and the impact on the investment income. I'm Farooq Zafar from the BIBF Center of the Banking and Finance. In this webinar, you can say it's a for 50 hours maximum for webinar with the last 10 minutes question answers. We shall discuss briefly and but for the impact of the expected corporate tax on the portfolios. So we have the major three topics. So out of three topics, third topic is our main topic. I will introduce something about the corporate tax and the tax classification and development in the region. Then we shall discuss in the GCC which country has the corporate tax and what are the corporate tax rates are the implications are there. And then finally we'll move to our main topic under corporate tax, which of the investment income are exempt and when they can be exempt, and otherwise which income are the taxable income. Finally, in the last 10 minutes, we'll keep a session for your question answers. So feel free to ask any question for the corporate tax, expected corporate tax in Bahrain, based on our discussion here now. So let's move to our the first topic here, introduction to the corporate tax and the tax classifications. As you all know, in the last year, in the May 2020, May 23, it was announced by the Minister of Finance that Bahrain is preparing for implementation of the corporate tax. Yet, since we are attending this session, there is no exact information by the authorities that when they will exactly announce something. Last week, the some MPs also submit proposal in the parliament for implementation introduction of a corporate tax. But still, when we taking this session in Bahrain, we don't have any for the announced date for the corporate tax and the rate for the corporate tax. But yes, our GCC region is heading toward for the changes in the tax landscape. So we have a direct taxes, we have the indirect taxes. So far in Bahrain, we have the indirect taxes, except for any company who work only for the oil and gas sector, they have specific taxes applicable only for that sector. So direct tax, as you know, direct tax is the taxation linked with that income, linked with the gain, linked with the profitability. More income, more taxation, lower income, lower taxation, no income, no taxation. So this is also called for the progressive taxation, so which link with the income gain, profitability. But on the other side, we have the indirect taxation, famous form, except for Kuwait and Qatar, whole GCC, we have the value added tax. Some other state in the world, they have the general sales tax. Then we have in Bahrain, except for the Kuwait, we have excise tax, we have a custom duties, and we have the other duties. So indirect tax means you will buy something or you will sell something. If on that item the tax is applicable, so we have to pay the tax irrespective who you are. It means this taxation doesn't consider your type of income or your affordability. It is considered one part. If you buy something, if you sell something, and as per on that item and service, as per the state law, if the tax is applicable, so we have to pay the taxation accordingly. So on the other side, now we're moving toward the direct taxation, and will be surprised in this session, except for in Bahrain. In other GCC state, we have the some kind of the direct taxation. almost every state have a corporate tax or the corporate income tax, or even somewhere we have a zakat. So corporate tax, income tax, corporate tax taxation for the business entities, income tax applicable only if any individual will earn the income. In the whole GCC so far, we don't have any kind of the income tax separately for the individual's income. Capital gain tax, again part of our direct taxation, but so we have a capital gain tax, but it's a part of the corporate tax in the GCC, the state which who have implemented the corporate tax. So again, in Bahrain, so far we don't have any taxation, but yes, we are moving toward for the corporate taxation. So it is also known as corporate tax. It is also known as corporate income tax. Even somewhere it is used the wording for the business tax, but the main name is the corporate tax, or you can say for the corporate income tax. So this taxation is only applicable if my income is a taxable income. So we shall discuss in this session, income under corporate tax will be taxable income, income under corporate tax may be exempt income. If exempt income can meet the criteria, in that case, no corporate tax is applicable, so income is exempt. In certain cases, some income can be out of scope. So we shall discuss which income can be out of scope from the latest practice in the region. And one more perception, generally we perceive corporate tax is applicable, like I mentioned here, it's a form of direct taxation. Direct taxation means if I have the profitability, I will pay tax. If I have the gains, I will pay tax. If I have a net income, I will pay tax. But this is not a general treatment here. No, we pay the corporate tax not on the accounting profitability, not on for the accounting net income. Actually, we convert the accounting net income into for the taxable income. So under taxation for each state, we perform multiple kind of adjustment, we deduct multiple kind of leave as per the local laws, as you can see on my screen here. So we primarily take a business net income and profit and loss as per accounting. So accounting as per IFRS based accounting, but in the world you can even use for the GAAP's accounting, but in GCC only for the IFRS based accounting. So actually we take business actual and profitability or net loss as per the accounting. Then as per taxation, we make multiple kind of adjustments. We some are add back, some are the reductions are there as per the local taxation laws. And finally, we convert accounting profitability into the taxable income. This is also known as taxable income or taxable loss, or adjusted income or the adjusted loss. So corporate tax is actually applicable on the taxable income, not on the accounting net income. So it's a perception that if my income is posed for the in business for the 1 million, so corporate tax will be applicable. No, this income is used to compute for the corporate tax calculation, where we perform under corporate tax multiple kind of treatments. We perform multiple kind of adjustment as per the state law. And finally, we convert our accounting income into for taxation income, tax adjusted income. On that income, if qualified, then the corporate tax would be applicable. So as you can see on your screen here, I prepared the two examples here. Under one example, our starting accounting profitability is the 1.5 million. Even second example, accounting profitability is the 1.5 million. So as per the corporate tax general principles, I perform many adjustments. I perform many of deductions. Like I perform adjustment for the unrealized gain and losses, the gain losses as per accounting treatment as per the revaluation model, but these not a realized gain. So a corporate tax may be add back, may be deducted as per the law requirement. Less exempt income. We shall discuss some incomes are exempt. So exempt income, if we have on the exempt income, because name says it's exempt income, though no CT is applicable. So exempt income is a part of company's profit and loss count, but in exempt income is out of side of the corporate tax there. So exempt income we deduct from the corporate tax calculation. Then if any relief is applicable, maybe restructuring leave, maybe small business leave, many other kind of deductions are there, interest deductions are there. If these are allowed as per the local law, so we deduct as per the law requirement. Then we add back many expenses. These are allowable as per accounting profit. Even these are gaps or these are the IFRS based principles. But these are not allowed as per the taxation. State to state, these are deductible expenses, they vary. So we add back all the non-deductible expenses, and then we make a TP adjustment. Remember one point, when the corporate tax will be implemented in Bahrain, immediately second tax compliance will be for the transfer pricing. Saudi Arabia, full transfer pricing, Qatar, transfer pricing, Oman, transfer pricing, even for UAE, they all have the transfer pricing. In Bahrain, we have a transfer pricing, but just a one part as per the CBCR. But under corporate tax, if you buy and sell something with the group companies or any company, any person where you have a control, if transfer pricing conditions are met, all the transaction must be at a fair market value. So you can say it's my group company, you can say it's my out of country branch, I can charge below market value, I can charge only cost, I will not charge something. It's a group management policy. But as per corporate tax, all the transactions, when we have our control entities, it must be as per the transfer pricing. So under transfer pricing, something we have to add back, sometimes we have to make reduction as per the transfer pricing complex adjustments. Finally, we did also for the tax loss relief. And the last figure in the bottom figure is called for the tax adjusted or taxable profit or loss. This actually figure is used, which figure is here is the 1.47 million. This figure is actually used to determine whether I will pay corporate tax or not. Accounting profitability is just a base figure and we make many transaction adjustment in that figure. And you can see in the both examples, both sides it's the same accounting figure, 1.5 million, 1.5 million. But when I perform adjustment as per of learning of examples there, on the first example, we have the taxable profit. This taxable profit is subject to further corporate tax. On the other side, accounting figure is same, but my adjustments are different based of different data. So my profitability is converted into for tax loss. So if tax loss, no corporate tax is applicable, and this loss can be used next year for adjustment against for the next year profitability. But if the taxable profits we have, in that case, we have to pay or charge for the corporate tax. So we decide at a starting phase here, corporate tax is applicable only on the taxable income, not on the accounting income. Accounting income is used to compute for taxable income as per taxation laws, where we make as per the state laws many kind of adjustments. Something is add back and something is the deductions are there as per the state law. And finally, we reach up to one figure. Figure is called for the adjusted profits, taxable or taxable income, or the taxable losses are there. If losses we will carry forward to next year, it means next year if I will have profitability, I can use those losses. But if I have the profitability for this year as per taxable, on this profitability as per state law, corporate tax is the applicable here. So we define here, as we discussed at the start here, corporate tax is the famous form of a direct taxation. Direct taxation means, as you can see a specific example, if there is a taxable income, then we have to pay the corporate tax. No taxable income, we have a taxation loss in this year, no corporate tax. Next year, I can use the same loss to offset against for the next year's taxable income, but definitely as per the taxation rules as well as the taxation procedures, which will vary state to state. Some are common, some will always vary for the state to state. But general principle is the same here everywhere. Taxable income or taxable profitability loss is used to compute for the tax liability. So we discuss at the start here. So corporate tax is the one of the form of the direct taxation. So as per direct taxation, we discuss many cases are there. So we have a direct taxation, famous form corporate tax, income tax we don't have in the whole GCC. Income tax, when we use the wording, income tax is only applicable for the individual's income, salaries, their personal investment, their personal rental income, like of those ones. So corporate tax, or we say corporate income tax, or we say business taxation, applicable only if it's a legal entity, maybe some shop, it's a sum of the company, maybe small or medium, but it made the profitability or it made a loss. It is subject to for the corporate tax here. So we define here the corporate tax is applicable on the taxable profitability or the taxable loss, not on the accounting profitability. So primarily I have net profitability as per accounting, but when I convert into taxation profits, into taxation loss as per taxation laws, you can see in the example number 2 for this year, there's no liability for me. But as per example number 1 here, there will be liability for me then as per the corporate tax. So now we shall discuss in the next stage here now. In the GCC, which country has implemented corporate tax, maybe fully or maybe partially, and which state so far don't have any corporate tax. But when I will use any date in the corporate tax, I will use any band in the corporate tax. Always remember, we pay corporate tax on the taxable income, not on the accounting profitability. Accounting profitability are the base figures which are used to compute as per liability, but as per taxation laws. So I hope this point is clear. If you have any question, write down with yourself and I will answer by end of the session. So moving forward to our next topic here, status and rate of a corporate tax. Except for Bahrain, in whole GCC, we have either corporate tax or we have the zakat. It means kind of direct taxation. As you can see on your screen here, except for Bahrain, we don't have any corporate tax. We're waiting. So somewhere, maybe this year sometime, maybe sometime government will announce something, the exact rate and the exact date. But you can see on my screen, UAE, they have a corporate tax, Oman, corporate tax, Qatar, corporate tax, even Kuwait and Saudi Arabia. although their mechanism is something different when it is applicable, but when it's not applicable. But by default, they have the corporate tax. Bahrain is the only country so far where we don't have a corporate tax. You can see the UAE, the latest regime, which they implement corporate tax last year, 1st of June 2023. And we'll use the US example because it is most refined, it is more equal corporate tax for everyone. As you can see for Saudi Arabia, if the business is owned by Saudi national or any GCC national, in that case, on the business profitability, but again, tax profitability, convert into this tax profitability as per zakat. So they shall pay only 2.5% of zakat as per the Sharia laws. But in Saudi Arabia, if any business, maybe business is owned by the any local resident entity, may be owned by the any foreign, but in Saudi Arabian territory, in that case, they shall pay corporate tax in Saudi Arabia for 20%. So in Saudi Arabia, if it's owned by the Saudi national or GCC national, then 20% they will pay zakat only. But if these are non-Saudi national or these are the non-GCC national, in that case, anyone conduct any activity in Saudi Arabia, they will make a profitability as per corporate tax. They know the rate of corporate tax is 20% of our taxable income. And I illustrate you how we compute the taxable income as of the basic example. Then for Kuwait, again, they have a corporate tax. If business is owned by the Kuwaitis, if it's owned by for the GCC nationals, in that case, there's no corporate tax. But in Kuwait, 1% zakat is applicable for all the public traded and the closed shareholding companies only. They will pay only for 1% zakat. Apart from this, they will pay 15% corporate tax. But when if business is owned by non-Kuwaiti national or the non-GCC national, so they have something in Kuwait, so they will pay in that case for the corporate tax of the 15%. So you can see they have a corporate tax because generally we perceive GCC is a tax-free. No, we have a tax-free, but not a whole tax-free. Every state almost except for the Qatar and Kuwait, we have the VAT, we have the excise tax, custom duties applicable in the whole GCC. Even you can see on the screen here now, apart except for Bahrain, all the states have a corporate tax. But difference is only how and when they will implement corporate tax. Like see Qatar. Qatar again partially means here not it's applicable to everyone in that state. They make us some differentiation. If GCC national treatment different, if non-GCC national treatment is different. Same for Qatar. No tax if business is owned by Qatar national or GCC national, but in this case, that GCC national will live in for the Qatar at least in 1 year for the 183 days. Otherwise, corporate tax will be applicable. So Qatar, no corporate tax applicable if any entity is owned by Qatar nationals or the GCC nationals who are the Qatar resident. If you don't meet this criteria, anyone apart from Qatar national, apart from GCC national, they will own any entities in Qatar and they will make a profitability. So corporate tax applicable 10% of the that taxable income. Oman implement corporate tax since 1984. Again, Oman have a two rates. One is the 3% only for the SMEs. If you're not a SME, SMEs means in this case here in Oman only, SMEs in this case here, their base capital must not exceed by the 50,000 Omani Riyal. In base in 1 year, they must not have the 15 and more of the company employees. Only in this case, can be called for the SMEs for the corporate tax purpose. Plus, base must not deal in air and sea transportation, banking, insurance, financial services, extraction of the natural resources. If all conditions met, only in that case, this is called in one for the SMEs and eligible for the 3% corporate tax. But apart from this, anyone in Oman, they will not meeting this criteria. It means corporate tax rate is the 15% is applicable. But UAE, a latest member in the corporate tax club. In the UAE, there is no differentiation who is the business owner in the UAE. Maybe GCC national, maybe UAE national. No, doesn't matter there. No, I will own some activity in UAE. Maybe in the personal capacity, I have some shop there. No, any company, any establishment, any branch of the foreign company, I will earn some income from the UAE territory. In that case, whole income is subject to corporate tax irrespective who you are, except for the government entities. So UAE recently implement corporate tax. Recently means for the last year they joined the corporate tax club, 1st of June 2023. Whose the corporate tax rate is the 9%. But again, 9% of our taxable profitability, which will exceed 375,000 UAE dirham. It means if the income is for the 1 million, out of 1 million taxable income, for 375,000, there's no corporate tax. This is called for the zero rate slab. Excess of 375,000, That is a 725,000 as per the 1 million. Corporate tax is applicable for the 9%. So state have the power. State shall decide. I will keep a corporate tax rate same. As you can see, Kuwait and Oman, their main rate is same. Saudi Arabia 20%. So rate will be vary state to state. When to implement, to whom it will be implement, it will be vary for the state to state here. No, but UAE they again follow for the international practices. Same for the European Union, same for UK and most of countries. It's a practice of those countries. If the income is subject to corporate tax, even after making the taxable income, they give some slab. Country to country, the slab will vary. But in UAE, the slab is the 375,000 dirham of taxable income. So for 375,000 taxable income is 0% tax, means no tax. Any excess, for example, taxable profitability is the 1 million. Out of 1 million, 375,000 is the 0%. So income is applicable. You will must go for registration. Everything is applicable. But for the first 375,000, there's no corporate tax. Rate is 0%. Zero means again zero. But anything exceeding, suppose out of 1 million, exceeding amount is the 725,000 for the 625,000, sorry. So in that case, excess amount is subject to for the corporate tax. So applicable only on the excess. Most of countries in the world, in the European Union, again for the Asian countries mostly, and for the UK, they always have this kind of slab. So country will decide, I will give a slab, or I will not give a slab of 0%. And by the way, in the UAE, the slab of 375,000, this slab is exactly equal to mandatory threshold of the VAT registration. Like in Bahrain, our mandatory threshold of the VAT registration is 37,500 BD. So in UAE, the threshold is 375,000 UAE dirham. So same slab rate they have used for the sake of the corporate tax. So for 375,000, 0% excess is the 9%. But in Bahrain, when we're taking this webinar, there's no corporate taxes applicable here. Yes, we're heading towards the corporate tax and we're waiting when government will announce something. They may announce anytime in this year, maybe for next year, so state will decide. But you can see here, except for Bahrain, everyone have a corporate tax or a type of the corporate tax, means for the zakat system. Zakat is again, no profitability, there's no zakat. If I will make some extra net income, then zakat is applicable. So status of a summary status in the GCC for the corporate tax. So now we're clear what's the corporate tax is not only in Bahrain. Apart from Bahrain, all the states have the corporate tax. Our third and the main topic here, see, even the session name was the corporate tax and the implication on the investment income. Because UAE is the latest regime and the UAE second thing, there's no differentiation who own the business. Simple one thing, I will earn something there of the territory. So if I will make a profitability, tax is applicable. So for sake of latest learning in the for the region, we shall use for the UAE's examples in our next learning. Although by end of session, I will give a comparison to you, Saudi Arabia, Kuwait, Qatar, and Oman, but UAE is the more refined and the latest implementation of corporate tax in the region. Even they are morely aligned with the Pillar 2 of taxation rules there. So we'll discuss briefly for the UAE, what we have learned from that state recently for the corporate tax, because something is common, whole disease, something will be different. Difference I will show you by end of the session. So moving forward here in the corporate tax, we have the third topic. So third topic, we will discuss two parts. One part under corporate tax is called for the out of scope income and one is called for the exempt income. If your income is the out of scope income, as per out of scope income, you are not required to go for the CT registration. CT registration is only applicable if your income is taxable income or your income is the exempt income, because exempt income is applicable meeting conditions. If anyone making exempt income must go for CT registration, and income will be not subject to corporate tax. But if income is the out of scope income as per corporate tax, Bahrain, Saudi Arabia, Kuwait, Qatar, Oman, and UAE, it is only for the natural persons. Being legal entity, being the business entities, either my income is taxable income, either my income is exempt income. If that source of income is not present in my slide, it means remaining all kind of income. These are the taxable income as per corporate tax. So first of all, same for Saudi Arabia, same for UAE, same for Oman, same for Qatar, but it's the latest case by the UAE. So these are the out of scope income. Being individual, I will do one job, I will do three jobs. Job is a full-time, job is a part-time, job is a job. Whatever I will take out of employment income, that is the out of scope income, but only for the natural persons. Same for the latest for the UAE. Second, interest on bank deposit. irrespective of the amount of deposit, irrespective of the amount of interest which I shall receive from the banks. Being a natural capacity, in natural capacity means I will use my personal account. If I use any business account, in that case, tax is applicable. So I will execute transaction using my personal account only, but I will take any kind of interest from the bank deposit. Short term, long term doesn't matter. Amount doesn't matter. Even amount doesn't matter there, no amount of interest. Whole income is the outer scope of the corporate tax. Same in all the GC states. Third one being in natural capacity. I will buy land, I will sell land, I made a gain. Income for me, income is out of scope income. I purchase government T-bills, I purchase other company securities, I purchase shares, I purchase other company bonds. I purchase and dispose of. On purchase and dispose of, I made a gain, out of scope income. I receive dividends, out of scope income. I receive interest on the bonds. These all are the out of scope income. And lastly, in UAE, what we have learned being individual, you are living in Bahrain, even buy property in the UAE. All the rental income in the UAE, all is subject to out of scope of the corporate tax if it's earned in the by individuals in the personal capacity. Income earned from the UAE property, buying and selling out of scope, rental income is out of scope, but this is only applicable if this earning is only in the individual capacity, means being in the natural person. If you are the legal entities, in that case, you don't have any out of scope income. Either your income is a taxable or your income is the exempt income. So we discuss first part here being the individual, wherever you want to invest, no limit as per threshold in the whole GCC. Whole income is the out of scope income. Out of scope income means no taxes applicable. Out of scope income means no CT registration is even applicable. No CT registration, no CT returns, nothing is applicable. So it's the income for that person and he will enjoy the income or she will enjoy the income. But our topic will be different topic no here, no exempt income. Then again, latest by the UAE. Then because UAE used for the more refined and the more best strategies to attack investment in the country, also make a profitability for the business, but also give some relief for those business. So in UAE, when we're taking this class here, no, it's no bit more than almost 1 year in the UAE, they implement corporate tax. Any UAE-based company, any UAE-based business, which is we use the wording for legal entity, if they receive a dividend income from any local company, irrespective local companies, big company, small company, but it was given by the local company, whole dividend income is exempt. But all dividend income is exempt. Any kind of capital gains, these are not exempt. So first part here, no types of the exempt income. So in my slide, E stands for the exempt income. So in UAE, what we have learned, domestic dividend income only. If it's not dividend income, in that case, full tax is applicable on that income. Purchase and sale of shares, tax is applicable. Purchase and sale of local companies for debentures, for the bonds, tax is applicable. Any other interest, tax is applicable, but only for the dividend income from the local companies. That is the exempt from the corporate tax. Second thing you can see on my slide here, no, foreign dividend income. I'm living in the UAE, being a legal entity, I purchase foreign entities shares. So in this case, I can buy their shares, I can buy any securities by default. Any securities means maybe these are the debt securities, like for the bond and debentures. By default, all income is the taxable. So T stands for here for the taxable income. So again, foreign dividend income by default taxable. If certain conditions met, then these are subject to the exempt from the VAT. We shall discuss what are those exemptions are there, and we're expecting maybe Bahrain will follow for the same practice. Then income from participating interest, we shall discuss and learn today what's the meaning of participating interest and what is the meaning of the participation exemption. Because UAE, they've implemented this participation exemption. So we shall discuss briefly for these conditions here. Third thing, in income from the foreign permanent establishment, I'm a company based in the UAE. My office is also out of the country there. No, so all of my income of out of country, even tax for the UAE, unless I will meet for the exempt income requirements. So you will pay for double taxation. It can be only about if your country have a double taxation or DTA agreements. Last thing which you have declared, I am living in Bahrain, I am living in Saudi Arabia, I am living anywhere in the world. But in UAE, I have an income. I earn income only from the sea transportation, only from the air transportation. But in UAE, I don't have any office, I don't have any branch. My ships go there, deliver, offload, and unload the items and come back to out of country. For the flights, take off in the state and take the passengers, and again they will leave the country. All in this case here, if they have office any in the UAE, any branch in the UAE, in that case full income is taxable. So non-resident person's income operating in the international transportation, but only air as well as the sea transportation, road transportation, all the cases taxable. So what is or not in the screen? Automatically, all other kind of income earned by the business, irrespective small, medium, or the big one, these are the taxable income are there. So simplify because topic is the investment. Investment means only for the third investment. I will buy local company shares. They will pay me dividend. Dividend income is exempt income. Apart from dividend buying and selling of those shares, I made in trading income is a taxable income. Taxable income means if exceed by the thresholds, which tax is applicable by 9%. Foreign dividend income by default, standard case, taxable is applicable. Only exempt is applicable if it will meet for the exempt criteria, which we shall discuss today. Now, as of the summary, what are the exempt conditions? But by default, apart from this, I purchase any company bonds, any company debentures, government T-bills, I receive any interest income. Buying and selling, I made any kind of gain. Straightforward income is a taxable income. So exempt is only for domestic income. In the UAE, then I will give comparison to you with the whole GCC. Then as well as the foreign dividend income or the foreign participating income. If participating conditions met, only in that case, income would be exempt. Otherwise, everything is the taxable in terms of the portfolio. So it means in the state being the legal entity, I will take up any kind of gains. I will gain local or international taxable. I will take up any kind of the interest, local interest and interest taxable is applicable. Exempt is for applicable only if it's a local dividend income. And otherwise, all the foreign income in the form of dividends by default taxable. If conditions met, then these are the exempt income. So income from the investment may be within state, may be out of state. So by default, within state investment income in the form of gains taxable. In the form of the return on the investment and dividend income, that is exempt only. Foreign investments by default all are taxable unless it will meet the criteria to be called as per the exempt income. You can see here it's a UAE based entity. It's a resident in the UAE, maybe only office, maybe only shop, maybe it's a branch of any foreign company, but you are physically in that state here. I will make investment out of my country, irrespective debt investment, irrespective these are equity investment. I will receive a return. So by default, all the returns are taxable for the corporate tax. Returns on income taxable, even any kind of gains on those securities, these are the taxable income here. So by default, these are taxable unless it will be criteria to be called as per the participating exemption or it will be called for the participating for the interest. So we discuss here a taxable entity in your state. Your state is supposed for Bahrain. State is we're taking the example from the latest by the UAE. I will make investment out of my country. Which is the other country doesn't matter here. No, I will receive an income. If I receive income by default, all income is the taxable income unless it will meet the mandatory six conditions. If all six conditions met for each investment portfolio, one investment in Spain, one investment in USA, one investment in Japan, one investment in Saudi Arabia, for each investment portfolio, if all the six conditions met, only in that case, income is the exempt. Which income is exempt? Every income is exempt. You will receive any gain buying and selling, exempt. You will receive any dividends of that investment of equity shares, these are exempt, but only for the equity investments. So we'll discuss here now. By default, treat all the foreign investment income as per the taxable income unless you meet for the those participation exemption, because this exemption is not applicable, not available even in Saudi Arabia, Oman, Qatar, and the Kuwait. There, you will introduce this participation exemption, which is as per the new reforms in taxation. So by default, everything is taxable unless it meet for the mandatory conditions, but it is only applicable if meeting all the conditions, but only for the equity investment. If the investment is out of country and the debt, in that case, receive any kind of gain taxable, any kind of interest taxable. So this is a relief is available, or you can say this exemption is available only for the equity investment out of country. So what is the condition here now? I will buy any company stocks, maybe ordinary shares, maybe preference shares, maybe redeemable shares. but my investment in that company is at least 5% and more of that company share capital. If this investment is below, in that case, basic condition is not met. So when we use the wording taxation in the UAE, in any country, participating interest means how much I participate in any foreign country's equity. So take all kind of equity irrespective, but don't take any, we can't take any kind of the debt investments. Any kind of equity, ordinary shares, preference shares, these are the redeemable shares, but these are the part of equity as per the IFRS requirement. IFRS will define equity statements there now. So in this case, if it will qualify for the participating interest, basic condition, my investment should be at least 5% or more of the foreign company's share capital. And you can take up all kind of share capital which you invest in that company. But this test we perform, this status we check for each portfolio separately. It means 5 portfolios, for each one check one thing. Do I have this threshold or not? If no, no exemption is applicable. If yes, then I will check if I'm meeting all these 6 conditions. In that case, I may qualify to get for that income, and that will be exempt. Which income will be exempt? If further 6 conditions met: dividend received exempt, buying and selling any kind of gains, these are exempt there. But at that time, condition must meet to be called for the exemptions there. Saudi Arabia, Qatar, Oman, and for the Kuwait, these exemptions are not available. They have some different criteria, but you use for the something new tax reform to attract more investment in the country, make investment out of country, come to the country to make investment. You will make profitability and state will also make profitability if the conditions met in terms of, so state will also take the income in terms of corporate tax. So first condition, I will make investment in the foreign country, any of the foreign entity. In that investment, I have already held at least 12 months, or I have intention if you purchase something by end of this year, because the year is ending on November, return is due suppose for 31st December, but on this date, I have a sort intention of my company that I will hold investment for the continuous 12 months time period. If 12 months are completed, maybe past, maybe intention is I will hold for coming 12 months, first condition is met. So basic condition was investment in the equity must be 5% or more, then subject to for the participating interest conditions met. If further conditions met, then whole income is subject to exempt. Second status, we discussed at a start, Saudi Arabia corporate tax rate 20%, for the Kuwait, for the Oman 15%, Qatar 10% there now. Any country where I made investment in that country, they should have a corporate tax, and their corporate tax rate should be at least equal to or more than of my country. Like we use the example of UAE. UAE corporate tax rate is 9%. So from UAE, suppose I make investment in Germany, I make investment suppose in Bahrain. Bahrain, we don't have a corporate tax there, no. It will not qualify. The state must have a corporate tax, and corporate tax rate must be equal to or more than of your local state. If corporate tax rate is lower, again conditions not met. If rate is more, it's fine. So it should be at least equal to for the local rate. Like UAE rate is 9%, so second condition met. Third condition, I am not bound by any agreement. I am free. If the entity will make any profitability, I can receive, because participating interest means at least 5%. I am not bound by any agreement, by any of consent, by virtue of my consent, that I shall not receive any dividend. I have right to receive dividends at least 5% or more if the company will make a profitability. You can't put any restriction on this investment. If investment is more than 5%, but due to some legal constraint, due to some agreement, you sign something, okay, fine, I will not take a in right of profitability in my entitlement 5%. In that case, conditions not met, I should be free, I'm entitled. If foreign company will make a profitability, I should take up, if they will distribute profitability at least 5% and more. Right to receive liquidation, if that company is wound up, maybe bankruptcy, maybe liquidations are there, no, I have right, if after clearing all the liability something is left, I can receive at least 5% of that proceed. Again, any restriction on this condition there, no income condition met, it means again income is taxable. So basic condition 5% and more, then all 6 conditions met. Only in that case we will say that my investment is the participating interest. So if investment is a participating interest qualify for each year, in that case, whole income from that investment, dividend and the trading income, whole is the exempt income. Fifth invest case here now, how much I should invest in that company. I will invest in the company. Shareholding should be 5% and more. And value of my investment, value of investment means actual purchase price of the investment, what I paid or I shall pay, plus all the acquisition costs. It must be for each portfolio in each company more than 4 million UAE dirham, which becomes equal to the 400,000 Bahraini dinars. If this portfolio amount is lower, acquisition cost is lower, it's a 3.5 million, doesn't qualify. All six conditions met, then it is qualified. The participating exemption will be your qualified. So participating interest means my investment is more than 5% of the foreign company's total value of the equity. On when all the 5% conditions met, I met all six conditions. Only in that case, this is called my participating income exempt from as per the local law. So as we discussed here, the basic point here for this, what we covered earlier here, by default, you will make any investment out of country, within country. There no, all are subject taxable as per the local law, except for only local dividends. Local dividend will pay to any local company, irrespective who is that or local company's owners are there. But I receive within my state. Local dividend is the exempt income only. Apart from dividend income, buying and selling, trading, again taxable. Foreign companies, dividend investment, foreign company participating in investment, if conditions are not met, what we receive, everything is a taxable. What we receive again means income from interest, income from the dividend, income from the buying and selling. Apart from the equity investment, I purchase out of my country any foreign companies bonds, any foreign companies debentures, or any foreign countries of the T-bills or the sukuk bonds. I made income in the form of interest. I may make income in the form of trading. All income is the taxable income. So this is what does it mean to be called as per the corporate tax. What is the meaning of the participating interest and when those the investment incomes are exempt. But for business, these are only are the exempt income. Apart from this being business, if you have investment in the real estate, investment in any kind of the land and the buildings are there, straightforward taxable income. So we define at a start. Out of scope income is only for individuals. Same for Bahrain, same for Saudi Arabia, UAE, Oman, and Qatar there. So it's but for the UAE, for other state, when we use for the exempt income wording is in the text in the corporate tax law only for the legal persons. So legal persons income is either exempt income or the income is either for the taxable income. So I will show for the treat for the summary of the whole GCC for here now. P exemption we discuss participation exemption. Saudi Arabia not available, Kuwait not available, Oman not available, even for Qatar is not available. It's available only in the UAE. In Bahrain, United started we discuss we don't have any corporate tax. Second thing, dividend income. In Saudi Arabia, you receive within Saudi Arabia any dividend income being any legal entity in Saudi Arabia all subject 20% tax as per Saudi Arabian laws, unless this dividend income may be foreign company, maybe local company, but I will be holding their shares at least 10% and I will keep a shareholding with me continuous for 12 months. Only in that case, it is exempt from the for the corporate tax in Saudi Arabia. Otherwise, by default, all is the 20%. Kuwait, straightforward, all the dividend income is the exempt income. The Oman, local dividend income from Oman-based companies, they pay to Oman-based investor exempt income. They receive foreign dividend income, that is the exempt income here. Sorry here. And for Qatar, again, any dividend income received within country, received out of country, all are the exempt income. UAE, we just discussed local domestic dividends, these are exempt. Apart from domestic dividends, all the foreign income, maybe dividends for any company, they are not, if participating conditions are not met, taxable at per 9%. If participating conditions met, even dividend income is the exempt income. Same treatment applicable for the capital gains, but capital gain in this category means only capital gains of the equity investment, not for the debt investment. Debt investment, these are 10 taxable. So if capital gains here for UAE, we discussed domestic capital gains are there, no, foreign are 9% and the exempt. Qatar 10% for all capital gains, irrespective local are the foreign. Oman local are exempt, foreign are the 15%. Kuwait, all kind of capital gains may be disposed of local, may be disposed of the for the foreign. In that case, 15% corporate tax of the Kuwait is applicable. By the way, Kuwait use the wording for the corporate income tax. Saudi Arabia, Again, all capital gains are subject to 20%, irrespective local, irrespective these are the foreign capital gains. Only difference here, I purchase investment in the Spanish company and that investment I dispose of in the Spanish stock exchange. And the same company stocks are also listed in the Saudi Arabia. Only in that case, this gain is the exempt from the Saudi Arabian corporate tax. But otherwise, by default, all are the 20% for the corporate tax is applicable on all kind of the gains. So this was all of this session and for the treatment of the corporate tax, especially for the income. Income may be out of scope or income may be for the exempt income as per the corporate tax. No, I have done for my part. If you have any question, please let me know. So I will come back. I will. You can use your mic or you can type in the chat in the public chat. So I will be able to answer. So any question from starting up to the slide here, please let me know. So any questions? Okay, let me open your chats here. So any question, I'm here to answer as per the available information of the corporate tax. Apart unless I can't tell you when Bahrain will implement corporate tax and what will be exact rate and the some of the main treatment. But what we have learned from the GCC, especially for the latest regime in the UAE, I shared with you. So let me know if you have any questions about corporate tax, any of the exempt income, any of the for taxable income. And like finally, we discuss in this part here, as per the corporate tax, when these are subject to for the corporate tax taxable, when these are exempt, but any case being legal entity, they don't have any out of scope income. Out of scope income wording we use in the corporate tax only for the individuals. So I'm here in the chat box. If you have any question, please feel free to ask me that question. Please, any question if you have, please ask. I will try my best to answer that question based on the available information about a corporate tax. Okay, I will, Mahmoud, I will ask my team that if possible, we'll try our best to share with you. Don't no worries at all. So we'll upload I will check with my team, with Munira and Hannah. If possible for us, we can able to share, we will share with you. No, you can download then, okay? They will let you know after the session. So any other question, please? Sure. So if you need the slides, let me know. Just type here. So our team will keep the slide after the session into the relevant portal, or they will share the link with all of you, and then you can download. Yes, we have already kept. You can see on my slide when I was sharing with you can see here on the start of the slide here. I have already mentioned these are the copyrights 2022 to 2024. So these are protected by the copyrights. So any question up to here further, please ask me. My colleague has shared the email ID. So please on this email ID, send your email request. So we will send back the slides to you. No, see, okay, Imran, VAT is applicable only if you will sell something. If you'll buy something, then it's a applicable taxation. So VAT is applicable only, not only VAT. Whenever these are the indirect tax, it may be custom duty, it may be for the VAT, it may be for the other duties are there. No, they're applicable only if you buy something, if you sell something, irrespective who you are. You have any income, you don't have an income. You earn in only 500 BD, you earn only 100 BD. You have to pay the same amount of taxation. So it's a difference of the main taxation. So indirect taxation means it's not linked with the income profitability. It's linked with the transactions, buying and selling something. But when we say it's a corporate tax applicable if you will make a profitability, if you will make up for the gains, if you will make a net income, On that income, corporate tax is applicable. So not corporate tax only, any direct taxation, capital gain tax we discuss, no dividend income, no corporate tax, no gains, no corporate tax. Similarly, corporate tax means it's applicable on the business net profitability. No profitability, no corporate tax. More profitability, the more corporate tax. I hope I have cleared your questions, so please let me know. Yes, sure, Mahmood. We will also launch the more of the seminars. Plus, BIBF, we have already started from the last year of the corporate tax proper training courses, where we're using the best of the examples, especially from the UAE. But yeah, different from Bahrain. Once government will announce something, we will open many training courses of corporate tax, plus as well as the accounting for corporate tax as per deferred taxation. Okay. So, any further question, please ask me, and I'm happy to answer that question. Sure, Muhammad. My colleague has shared the email ID bankingpro@bibf.com. So in this case, send email on this email ID. It requests that we need for the slides. So our team will send you all the slides. Okay. So you can see on the public chat here, Munira has shared for the email ID bankingpro@bibf.com. So just send the request on this email ID. So we will send you the copy of that slide. Any question for the GP? Imran, it's difficult to say in this session. There are a lot of things are there. We simply think I can say you here, accounting profitability is just a base figure. We make a lot of adjustment in that we add back many kind of gains, realized and unrealized as per the corporate tax requirement. All the mis expenditure, for example, you incur a cost on the business entertainment, even you pay the interest to the banks. As per corporate tax, full amount may not be deducted. So sometimes 50%, some region 30%, sometimes 75%, but depending state to state. So we take all the accounting profitability as per profit or loss. Then we ask the accountants, we ask the accounting team, how you compute the profitability. I want to know all the source of income. I want to know all the kind of expenses which is allowed as per the GAAP's accounting, which is allowed as per IFRS space accounting, but they are not allowed as per the corporate tax. It takes a lot of time. Last week I had a session, so we spent approximately 3.5 hours to discuss briefly all the treatments which are part of accounting and they are allowed as per accounting, but as per taxations they are not allowed. So they should be either added back or they must be deducted. So many adjustments are there. These are expenses, these are capital gains, unrealized gains, these are losses, interest payments, then transfer pricing, then the double taxation if you pay corporate tax out of country in the foreign country branch, if you pay withholding tax in the foreign country. So how we adjust in that return. So it takes some time, but yes, if you'll come to our NF training session, so we'll discuss briefly that how actually we convert accounting profitability into the tax profitability. So any other question, please? So we have the 4 minutes before ending the session. If you have any further question, please ask. I will try my best to answer as of my understanding. Thank you, Ali. Thank you very much. I can't say anything because last time, Pradeep, I shared something of my thoughts. So sometimes people say Farooq said, so they will say, no, it's no, I cannot say something. So I can't say it's 9%, less than 9%, maybe more than 9%. But I tell you one thing, not for Bahrain. Time will come, maybe 5 years, 10 years, or 15 years. In the corporate tax rate in the most of countries of the world, it would be at least 15%. Because why? Bahrain has signed the global minimum tax agreement in the last year. So when they implement corporate tax, I don't know, 5%, 6%, 7%, 9%, 10%. I can't say anything at this stage. But yes, I can tell you one thing. 10 years, 5 years, time will come in the whole region, at least corporate tax rate should be for the 15% as per the global standards. UAE rate so far is 9%, and they said it will be still 9% unless it will move to up to for the 15% as per the global corporate tax minimum rate, because UAE is also signatory of that agreement. So ministry will, Pradeep, announce sometime what we're expecting from ministry, when they will announce the date when it will be applicable. And second thing, what will be read? And third thing, what would be the for the zero slab? So expectation is zero slab may be same like for the UAE, like equivalent to the VAT threshold. Most of principle will remain same. Difference would be only for certain exempt incomes and the exempt income conditions. And out of scope income I discussed, we do these are all the time for the out of scope of the corporate tax. So once they announce something, then we can say categorically at this stage, we can't say because we don't know what the authority has decided. Thank you, Imran. Any further question, please? Like you can see on the screen here, let me go back to the top part here. See on the screen, if you look at here or just for the last 1 minute, see some states are GCC national not subject to corporate tax. Bahrain may say, we don't know what government shall decide. Government may say if business is owned by Bahrain national or GCC nationals, in that case no corporate tax. If it's owned by the foreigner, then corporate tax, because you can see Saudi Arabia same treatment, Kuwait same treatment, Qatar same, even for Oman is not same like that. But UAE, they follow the corporate tax best of the best practices in the world, irrespective who you are in my country. If you're making profitability out in my country resources, in that case, CT is applicable. So expecting for Bahrain, they will follow for the maybe for those practices. But again, government can decide. They may say for Bahrainis, no corporate tax. If they own something for non-Bahrainis, maybe corporate tax. But government shall decide. We can't say at this stage anything because see how we can say we're not authority. Could you any further questions you up to here, please ask. So then we'll end up the session. And thank you for all of you for your time and participating in the session. I think we don't have any further questions, so we can end up the session. So thanks to all of you again for sparing your time to attend the session and your and you want to know more about our sessions for upcoming multiple kind of topics, you can check out BIBF website. Even the my colleague team member Munira has shared the link. You can click on that link. You can see what are the upcoming BIBF webinars on the multiple topics. So yes, once Ben will announce the corporate tax, we'll keep the many awareness sessions and the webinars on the corporate tax. Plus, we'll offer the more training courses. So thank you to all of you.